How does a financial giant like ICICI Bank, well, not just survive, but really thrive and innovate in a market as incredibly dynamic as India?
It's a fascinating question, isn't it? Goes beyond just the numbers.
It really does. It's about strategy, agility, foresight.
Exactly. So today we're doing a deep dive into the latest financial results and, the strategic thinking from ICICI Bank and its key insurance arms, ICICI Lombard General and ICICI Prudential Life.
Right. For the quarter ending June 30th, 2025, that's Q1 of fiscal year 2026.
Our mission really is to cut through all that corporate speak, the dense reports.
Yeah, get past the jargon. We want to pull out the really important nuggets of knowledge, the insights from their latest reports, their investor presentations.
Think of it like getting the inside track, understanding what makes these major players tick.
Hmm.
And by the end of this, you should have a really clear picture of their financial health, where they're focusing strategically, and what opportunities lie ahead.
Yeah, we might uncover some surprising facts, some key trends that explain how they're doing it. Okay, let's get into it then. Let's start with ICICI Bank itself, the foundation of the group. Looking at their Q1 performance, the profit growth immediately jumps out.
You're absolutely right. Their standalone net profit after tax, it surged to nearly, 12,800 crore rupees?
Hmm.
That's up at significant 15% from the same time last year.
Wow, 15%.
And the consolidated profit, including subsidiaries, also jumped over 16% growth, hitting roughly 13,560 crore. That's a powerful statement, isn't it? Shows real underlying strength.
And that strong bottom line, it flows right through to where it matters for shareholders' earnings per share.
Hmm.
We saw diluted EPS grow standalone from about 15.46 rupees to 17.63. Consolidated, it went from 16.32 up to 18.71.
These aren't small bumps. It shows that top-line growth is really translating efficiently to profit.
Okay, so beyond the profits, what about their key ratios? Do they paint a similar picture?
They do, absolutely. Take the capital adequacy ratio, the key measure under Basel III. It stood at a very healthy 16.31%.
Which means,
Well, it means they have a strong financial cushion. It signals they can handle shocks, sure, but more importantly, it gives them firepower to, chase new lending opportunities, expand. That's a real advantage in a market like India.
right, sets them apart.
Yeah.
And efficiency, return on assets.
Also improved. Annualized ROA went up from 2.36% to 2.44%. So they're not just getting bigger, they're getting better at using their assets to make money.
Okay, but you often say the real insight is in asset quality. What are those numbers telling us?
Ah, yes, critical point. Look at the gross non-performing assets ratio. It dropped dramatically, from 2.25% last year down to just 1.75% this quarter.
That's quite a drop.
It suggests really rigorous underwriting, good collection processes, and the net NPA ratio, stable at a tiny 0.22%. That just highlights their discipline in managing credit risk.
So that level of asset quality, that must give them a competitive edge, right?
Definitely. They can potentially offer better rates, maybe move into segments others find too risky. It's a strong position.
A really compelling story there. And on the balance sheet, deposits grew substantially too.
Oh, yeah. Hit over 1.6 trillion rupees this quarter. That's up from around 1.4 trillion a year ago. Shows strong public trust, means they're very liquid.
Which helps fund growth.
Precisely. It underpins their ability to grow without relying too heavily on, say, external borrowing. Now, something important to understand is the impact of strategic moves and regulatory changes on the consolidated results.
Okay, like what?
Well, the big one was ICICI Securities becoming a wholly owned subsidiary. It delisted back in March 2025.
Right, and that led to recognizing a big securities premium, nearly 6,900 crore.
Correct. But crucially, that acquisition also created over 5,500 crore in goodwill on the consolidated books.
Ah, so that affects comparisons.
Exactly. You need to be careful comparing consolidated results year on year because of this structural shift. It's significant.
Makes sense. Any other regulatory things?
Yes, they implemented the new RBI Master Direction on classification, valuation, and operation of investment portfolios. And that actually brought in substantial transition gains, a net gain over 2,000 crore. Shows they're adapting well to new rules.
And they also sold off some stakes. Streamlining.
Seems like it. Stakes in Pfizer Merchant Solutions and that NIT Training Institute, they're no longer associates. Suggest a tighter focus on core banking and insurance.
Okay. So diving deeper now, how does the bank actually make its money, segment-wise?
Well, it's pretty diversified. Retail banking is still a powerhouse, over 40,400 crore in profit before tax.
Wow.
But look at treasuries, nearly 37,000 crore. That highlights just how well they're managing their investments in this market. And wholesale banking added a healthy 21,450 crore too. That balance provides real stability.
And I noticed a new disclosure. Digital banking.
Yes, that's interesting. They're now breaking out digital banking as a subsegment under retail. It's not just accounting. It clearly signals how important digital channels are becoming for acquiring and serving customers.
That focus on digital and retail seems like a good bridge to the rest of the group. That tech-driven push, you see it reflected in ICICI Lombard too, right? Their non-life arm.
Absolutely. It's a great segue. Because with Lombard, we see growth, but there's an important bit of context needed.
Okay.
Their gross direct premium income, GDPI, it grew, but only by 0.6% to about 77.35 billion rupees. Now, on the surface, that looks low, especially when the industry grew almost 9%.
Right, so what's the story there?
It comes down to a regulatory change. A new one accounting norm for long-term products kicked in. Basically, it changes how they recognize premium income over the life of the policy.
So it spreads it out rather than booking it all up front.
Exactly. So if you actually exclude that accounting impact, their underlying GDPI grew a much healthier 4.8%. Still less than the industry's 12.8% on that adjusted basis, but it shows the reported number needs context. It's a reporting change, not necessarily a slump in new business.
Okay, that's crucial context. But profitability was strong despite that.
Very strong. Profit before tax jumped over 28% to nearly 10 billion rupees. Profit after tax up similarly, around 28.7% to 7.47 billion. And the return on average equity, ROAE, was an impressive 20.5%. Good returns for shareholders.
And their combined ratio, that tells us about underwriting profitability, right? It was 102.9%.
Right. So a combined ratio over 100, like 102.9%, means for every rupee of premium, they're paying out about 1.03 rupees in claims and expenses. So technically, an underwriting loss.
So how are they so profitable then?
Investment income. Their overall profitability relies heavily on making good returns on the premiums they hold before paying claims. It's a common strategy, especially for mature insurers, and it shows shrewd investment management is compensating for tighter underwriting margins.
Got it. That makes sense. And they're still a major player.
Oh, yes. Still the leading private sector non-life insurer, a position they've held since, 2004? Market share around 9.8% in Q1.
What about the mix of things they insure?
It's pretty spread out. Motor and damage is big, about 29%, and health, travel, and personal accident combined is even bigger at 34%.
It's interesting. Anything specific within motor?
Yeah, a bit of a mixed bag. Private car and two-wheeler premiums grew nicely, almost 10% and 7% respectively, but commercial vehicle premiums actually dropped significantly by 16.5%.
Maybe reflecting a slowdown in that part of the economy.
Could be.
Yeah.
And health GDPI was also described as impacted by muted credit disbursements, and that accounting norm we talked about shows how interconnected everything is.
And their digital push sounds like it's really paying off.
It's remarkable. Get this. 99.7% of their nearly 9 million policies were issued electronically. Think of the efficiency.
Wow.
And for group health claims, 67.5% of cashless authorizations are done using AI. That means speed, accuracy, better customer experience. Plus, their app, IL Take Care, has over 16.6 million downloads. That's serious customer engagement.
But with all that digital activity, how are they managing risk?
Seems very robustly. Nearly 87% of their debt investments are in super safe sovereign or AAA-rated securities. 0 defaults reported. That's conservative, disciplined.
Good to hear.
They also have a board-approved climate risk framework and certifications for enterprise risk management. So they're looking at broad long-term risks too, including ESG stuff.
And stepping back, the potential in India's non-life market is huge, isn't it?
Absolutely massive. Second largest in emerging Asia, 15th globally, but still way underpenetrated compared to the global average. Maybe only a quarter of the penetration.
And that cash before cover model is unique too.
Right, premiums paid up front.
Yeah.
Shapes how they operate. But yeah, the headroom for growth is just immense.
Okay, let's turn to the life insurance side then. ICICI Prudential Life. How did they fare this quarter?
Pretty well on the profit front. Profit after tax saw really impressive growth, up 34.2% year-on-year, hitting just over 3 billion rupees.
Nice. But for life insurers, the value of new business, VNB, is key, right? Future profits.
Exactly. That's the indicator of future health. Their VNB stood at 4.57 billion rupees. Now, the VNB itself was actually down slightly by 3.2% compared to last year.
Oh.
But, and this is the important part, their VNB margin increased to 24.5%.
So each new piece of business is more profitable.
Precisely. It signals they're writing a really profitable mix of business, likely focusing more on those higher margin protection products. It's a strategic choice, focusing on value over just volume.
Makes sense. What about overall premium growth?
Total premium was up a solid 8.1%. Now, their main sales metric, annualized premium equivalent, or APE, that was down 5.0% overall.
Okay.
Again, you need to look deeper. Protection APE grew strongly, up 15.2%, and retail protection APE up an even stronger 24.1%.
So it's clear they're strategically pivoting towards protection.
Definitely looks that way. More sustainable, higher margins. And they are massively expanding coverage, too. Total new business sum assured jumped over 36% year-on-year.
36%.
Yeah, to a staggering 3.7 trillion rupees. And the total amount of insurance they have in force grew over 17% to 41.1 trillion rupees. It's a huge number of lives covered, showing growing trust.
And operationally, are they efficient?
Seems so. Their cost-to-premium ratio improved, dropping from 24% down to 21.2%. Even better for their savings business. They attribute it to cost optimization.
Good. And are customers sticking around? Persistency.
Looks good there, too. 13th month persistency is high at 86.0%. That indicates customers are happy and they're writing quality business that lasts.
And this is amazing. 0 non-performing assets since inception. How is that even possible for such a large institution?
It is truly remarkable, almost unheard of. It points to incredibly strict underwriting and maybe a very conservative investment approach.
What's the benefit of that?
Well, it frees up capital and management time that others might spend chasing bad debts. They could just focus on growth and service. Plus, their assets under management grew strongly to over 3.2 trillion rupees, shows customer trust. And their solvency ratio is way above requirements, 212.3% versus the needed 150%. Huge safety buffer.
That reliability must be key. And they're using tech for the customer.
Absolutely.
Yeah.
Like issuing 54% of savings policies on the same day. And claims 99.6% settled, with non-investigated death claims turned around in just 1.1 days on average.
Wow, 1.1 days. That's fast.
That builds trust when people need it most. They've also launched something called ICICI PruStack, a suite of digital tools and analytics. The aim, to be the most customer-friendly and partnerable insurer.
Sounds comprehensive. What about their product mix?
Very diversified. Linked policies, like UEPs, are about 47%. Traditional non-linked savings are 22%, and protection is another 22%. So a good spread.
And how do they sell? Distribution?
Wide network. Bank assurance selling through banks is 30%. Their own agency force is 25%, and group business is 19%. Supports that diverse product range.
And behind the scenes?
They talk about focusing on people, tech, and analytics, using AI and machine learning for everything from finding leads to underwriting, keeping customers, and processing claims. It's about smarter decisions, not just faster ones.
And they're strong on ESG, too.
Very strong. Rated the highest-rated Indian insurer by top ESG agencies, and AA from MSCI. Plus 59 offices running on renewable energy. That's a real commitment.
And again, the market opportunity in India for life insurance.
Immense. You've got the demographics, large, young, growing population becoming more financially aware.
Right.
You've got a massive protection gap, something like $16.5 trillion back in FY2020. A huge unmet need for cover.
And pensions.
Still very unpenetrated, only about 7% of GDP. And life insurers have the exclusive right to sell annuities, those retirement income products. So clear paths for growth there. The market is just ripe for expansion.
Okay, so pulling it all together then, what's the big picture from this deep dive into ICICI Bank and its insurance arms?
I think the overall picture is one of, well, remarkable health and really smart strategic thinking. You see strong financials, yes, but it's underpinned by incredibly disciplined risk management.
Especially that asset quality.
Exactly. And a very forward-looking vision that truly embraces digital transformation.
Yeah, the common threads that stand out to me are definitely that deep commitment to digital, not just as a buzzword, but really integrated to boost efficiency and customer experience.
Right.
And that relentless focus on risk management and asset quality, plus the proactive approach to ESG, which is just becoming so important now.
Absolutely. And at the end of the day, these companies are just incredibly well-positioned to capitalize on India's unique market potential.
That massive, young, growing population, rising incomes.
Combined with the fact that financial services and insurance are still significantly underpenetrated, it creates this huge runway for growth. That's really the aha moment here, seeing how they're building a blueprint for success in this high-potential environment.
So that wraps up our deep dive into ICICI Bank and its financial family. We've really unpacked the key numbers, the strategic moves, and seen some impressive growth and innovation.
Leaves you with a thought, though. Given how fast India is adopting digital and that huge untapped market, how might this blend of traditional banking strength and, cutting-edge tech redefine financial services, maybe even globally?
That's interesting. What could other markets learn from this kind of integrated, digitally driven approach we're seeing here? Something to think about.